It's certainly a very different year to last year. Jurrien, what is the global theme most on your mind these days?
Well, of course, we have the global economy, even though it's strong, the growth rate has clearly peaked. But then in the U.S., we get this other sort of shot of growth coming from the tax cuts. And we have this reset going on, right? The market was on a one-way run higher over the last 2 years globally, the U.S. as well as EM and other markets as well. Record low volatility. But now the central bank theme is very much in play again. And to me, the markets come down to earnings and interest rates, right? And in the U.S. at least, earnings are booming. Q1 just basically wrapped up at 24% growth, which is really amazing 9 years into an expansion. But the R, the interest rate part of that equation, is clearly coming up. 10s are above 3%. You get this increasing pressure on yield spreads, and that's pushing the dollar up, and that's creating some pain in emerging markets right now. So we have this liquidity reset. Financial conditions are starting to tighten again. Everyone's wondering, how far does the Fed have to go to truly normalize or tighten policy? And of course, nobody knows the answer. But with an earnings boom, a known entity, the other side of the equation, the interest rate and liquidity side, is really where the battle is being fought.
And is that what's keeping a dampener on reactions to this earnings boom? Because we've seen the earnings boom, but stocks haven't really done all that much.
Exactly. So people ask me, why aren't stock prices booming if earnings are growing at 20+%? And there's two reasons for it. Well, there's three reasons for it. One is the market tends to not reward earnings growth that is that strong. Like, it rewards sustained 10% earnings growth, all day long. But 20–30% earnings growth is usually not sustainable at the market level. At the individual stock level, of course, it can be. So the market tends to not reward that kind of earnings growth. The other thing is, it's now known. Like, we know Q1's 24, Q2 and Q3 are likely to be above 20 as well, but it's now priced in. And then that other variable that I mentioned, the liquidity environment, is really what becomes the next big thing for the market. And so, the good news is that valuations are coming down. They were way too high. The PE's already come down 3 points since January, and it's being able to do that without knocking the market down. So it's a very benign reset, and in a way, the earnings are really like a bailout for an expensive market.